All right, guys, we are back kicking off room 2 here with our first speaker of the day here, the one, the only, the woman, the legend in California, legend all across the country, who's got a big heart for helping a ton of real estate investors, not only through what she teaches, but also through her radio show, millions of downloads in the podcast, the author of Rich in Rentals as well, too. Is that correct, right?
Retire Rich with
Retire Rich in Rentals. That's right. I had the book laying around here a second ago. But we are excited to have us joining this morning from from Florida, which is about 3 hours ahead of what she's used to.
Yeah.
The one, the only Kathy Fettke. So thanks for joining us this morning, Kathy. I know you're busy. You're getting ready to go on a cruise, a 7-8 day cruise conference as well.
Yeah, it's a real estate cruise with the real estate guys. I'm speaking with Robert Kiyosaki and Kim Kiyosaki, and it's a lot of big names there. It's great. It's already started actually here in Florida.
Well, awesome. Well, you've got some great stuff to share with us this morning on how to invest in syndications like a pro. So I know a lot of people are looking to take things big. We actually had Sharon Lechter on last night as our keynote, and that was one of her big things about how she's talking about and share with everybody to play big. So I love what you're going to be sharing with us this morning. It's a perfect way to kick off day 2.
Awesome. All right. So should I start?
Yeah, let's get some rock and rolling.
All right. You can see my slides because I can't see you anymore.
Yeah, you don't need to see me. Nobody wants to see me. They're here to see you and your slides. So we're golden.
Okay. All right. So we're going to talk about how to invest in syndications like a pro and to also syndicate. And so it's important to understand both sides of it. These are, there we go. So we're just going to kind of go over what a syndication is and the types of deals, the deal structure, the offering documents you need if you want to raise money from other people or if you want to invest in other people's deals, and how to join a project and what to expect afterwards if you are offering it or investing in it. So just very simply, a syndication is a group investment where a lot of investors come together to buy something bigger than they could do on their own. And the key that we've found for this over the many years, we started in 2010, I believe, to syndicate. The most important thing to be aware of when investing in a syndication is the management, the background and experience of the partner, the lead person. And it should be more than just one lead because there needs to be a continuity plan for if anything ever happened to that person in charge, who's going to run the deal because somebody's got to manage it. So the experience of the manager, the partner is the most important thing. You can get and find the greatest deal in the world, but if you don't know how to manage it or take it to fruition, it can fail. So, and I've experienced that where we found an amazing opportunity in the Oakland Hills, but the operator had not been experienced enough to know how to get through some of the curveballs that were thrown at us from the city of Oakland. The project ended up taking so much longer, and there were losses as a result of all the holding costs. But a more experienced developer would have been able to either get through it or see it before it happened. So again, you can find the greatest deal, but without the right team, it may not turn out the way you want. And if you're syndicating, same thing. If you're raising money from other investors, you have to understand that, there are serious laws around that and you want to do it right. And so if you are not an expert, let's say you found a great deal, but maybe you're not an expert. If you found an incredible apartment building or commercial building or a tape of single family homes or whatever you're investing in, but you haven't successfully done that over and over again, then make sure you bring in a partner who has, because management of that asset is everything. And diversify risk. That's one of the things that syndications help investors do. At least at Real Wealth Network, we have, oh my goodness, we've raised over 100 million now, have lots of entities, lots of different companies that we've formed. And what we found is many of our investors will invest $50,000 in each one. So they might be in 10 different deals that we've done, but it's significantly diversified because many of our our deals are all around the country. We actually are currently raising for a development in Costa Rica, which helps diversify even further.
Nice.
Yeah, I mean, Costa Rica is it's a unique kind of world-class health resort, but also a living community. And for most of our investors who want to be in that, they like the diversification outside of the U.S. because some of the cracks that people are seeing in the system and possible currency wars and so forth. So getting your money out is not a bad idea these days. So a syndication, if you invest in a syndication, you have very little control, if any. You might have voting rights, you might not. You need to read the documents to find out. So your complete and total trust has to be in that management and whoever's running the syndication, and because they're calling the shots. So you do lose control in a syndication versus just owning a property outright. And of course, it's regulated by the Securities and Exchange Commission, which means if you're raising money, you better make sure you're doing it right because you will be regulated. And if you do it wrong, there's serious penalties for that, which I didn't know when I first started, but yeah. So the types of syndications out there, entitlement deals, we do a lot of those where we just acquire raw land and entitle it for specific use, commercial or residential, and then sell to builders because builders don't like doing that entitlement process. It's so politically based. You have to get your local planning commission on board. And so we work with specialists on that and then just flip the property. So we don't take builder risk in a lot of cases. We just entitle and sell for a massive profit. I think I'll be talking about a few deals we did that were exciting, but where we tied up a piece of property for 10 million, entitled it, and resold it for 20 million. Investors were really happy with that.
That's awesome.
That was a good one. Yeah, that was a really good one. So we've had those same investors coming back after year, and that's what's great if you're a syndicator, is that money recycles, because when you get through a project, I think we raised on that one, we only raised $2 million, but as soon as that was over, people wanted to reinvest their $2 million. So you can keep offering deals when those deals come through. And then diversified single family rental funds. We have one of those too we offer. And I know lots of other companies are doing that because there's still such high cap rates in single family, but a lot of people don't want to just own a bunch of single family homes, but they want the high cap rate. So if you invest in a fund, you can get that and then not have to manage a bunch of properties. You let someone else do that for you. And then of course, apartments, you see that all the time, companies acquiring apartments, and you can invest as a shareholder or a member of that. Okay, so again, I just already went over it, but entitlement deals, the investment strategy is a type of piece of land. I'm not big on land banking. I know that's a thing, but I just think it's a kind of a waste because you got land but no income from it if you're sitting on the land. We've done it once because we bought a property worth $6 million. We bought it for $500,000 at the downturn. They were giving land away in like 5 years ago, so we bought it, and now it's worth about $9 million just a few years later. It's amazing. So sometimes land banking can work, but you got to get it super cheap. I don't think you're going to find much land super cheap these days, but back in 2010, 2011, it was, like I said, they were handing it out. So you could, tie up a piece of land, work with the regulatory bodies to approve the rezoning, the city planners. If you're in a no-growth area like Portland, that's going to be really hard to do. If you're in a area like Reno, where we're building currently, when we bought the land there, it was so easy to get entitlements. It took us just months. In Costa Rica, it took us a few months, even though it's normally a much longer process. So you need to understand the kind of the mood of the planning office and understand what they want. On that Dublin deal where we tied it up for 10 million and sold it for 20 million, we already knew what the city wanted, and we gave them that. We gave them residential housing near the BART station, which is what they wanted. And then again, sell it to a developer, let them take the builder risk. We just sell the land. And the nice thing about that entitlement projects is if you sell it, in one piece, basically, you entitle the land and sell the whole thing, then it is considered an investment and it's capital gain treatment, which is great because that tends to be lower taxes. The risks, there's serious risks on entitlements. You have to understand the market to estimate a property's worth, and you got to deal with the city, and that's never easy. So here's that deal I told you. We tied up, this is kind of a cool way to tie up land. We did a purchase and sale agreement, but it was more like an option where we only had to put down a down payment of 1.2 million on that 10 million, and we had a 2-year close, and that with a ability to extend it, because that person who owned the commercial building that had been there, he didn't have any idea what the city's plans were. This is a real key in any kind of development project, although I'm going to get into talking about fundraising in a minute. But it's if you know what cities are planning to do and how they're growing and revitalizing and investing in themselves, you can get ahead of that, because a lot of the locals haven't gone down to the city and found out what the plans are. So we knew that they were going to be completely redeveloping that area to the new downtown, and they wanted this commercial area to be residential, but the current owner didn't know that. So we were able to just negotiate a ridiculous deal of only having to put 1.2 million down over a 2-year close. And in that time, we rezoned it and then sold off, did a double closing, thought we were going to get 14 million, got 20. So we only had to raise like 1.5 million for that. That was pretty cool.
Nice.
I'm gonna just kind of go through that one. So if you're actually going to develop it, then you do take on that builder risk, which can involve taking on loans. And in today's environment, I would say that is the biggest risk with anything is financing, because we see interest rates going up. If you're on a short-term note of any kind, and then that the note comes due on say an apartment or something, and then interest rates are going to be higher this year or next year or the year after, that's going to really affect your NOI, and that's going to affect the value of the property. And you may have to put more money in to refi or to sell. You may have to take a loss. So any financing is probably the biggest risk today on anything. So on our land development projects, we just raise all the money from our investors to purchase the land and develop, and we'll build some homes, sell those homes to finance the next round. So we're really cautious about getting into any short-term financing on our syndications. And I think that's important for people to understand. We're heading into a new environment of higher interest rates, and that will have an impact as definitely on short-term loans. So there's that Reno project. I don't need to talk about that. There's the Costa Rica one. We bought 800 acres of land for $4 million and got it entitled, and we're building it now. It's going to be this really cool resort there that's all living buildings. So it's beyond net zero. It actually gives back to the earth. It's pretty world class. And then our fund. But let's get to deal structure and how you can, if you're looking to raise money, how you could structure it to make it attractive to others. You can do it as an equity partnership or a private loan. So Scott, I know a lot of your investors or the people listening are probably interested in notes. And so if you were, investing, if you were trying to raise money to create a note or buy a note, it's a little different than some of the ways we raise money. So I'm just going to talk about the way we raise it, and then whoever's listening, see how it applies to whatever you're trying to do.
Sure.
Okay. So with our deal structures, here's what we've found over the years is that there's 2 ways investors can come in and lend you money. And there's 2 ways you can invest, basically. I mean, there's, I'm sure, many more ways. This is just how we do it. You can come in as an equity partner, which means that you're a partner in the deal, or you can come in as a lender and come in, buying a portion of a note. And there's different ways that these are taxed. So it's important for the syndicator to understand that, because we want super happy investors, right? We want investors who are not going to end up with a surprise tax bill where they thought they were going to get, like you said, that 30, you saw that last slide, 36% IRR, and then find out they're getting taxed at 50% in their IRA on that. They might be upset if they didn't know that in advance. So you want to understand how your investor is going to be taxed in your syndication deal, or how you're going to get taxed in someone else's deal. So if you come in as an equity partner, it means that it's the same thing. If you were going to buy a house with somebody else, you guys might say, all right, we're going to split this 50-50. We both get 50% of the equity, or 60-40 or whatever. And so it's the same with a big syndication. If we're going to buy $10 million worth of land, we'll work out a deal 50-50 with the developer. We get 50%, however it is, there's different percentages. The benefit, just like if you were to go in with somebody else and buy a house, if you improve it, do a fix up of some kind, and then there's value added, then you share that equity, right? You just split the equity. But let's say the market turns, or you find out there's mold or things you didn't expect and it costs more, and there is no equity. So it ends up, let's say you bought a house for $100,000, you put $20,000 in, you thought you were going to sell it for $150,000 and split the equity gain. But that didn't happen, and you sold it for $90,000 or whatever. It didn't work. You put all this money in, that's loss. So the equity partners can either gain a lot or lose it. There's no guarantee. And so that's what you have to know when you're going into an investment, or, again, bringing in investors. How do you want to structure it? And if they're coming in as equity owners, partners with you, they need to understand the risk they face, which is that you could hit your target and then split all the profits, or you could not and nobody gets anything. And if there's losses, the money's gone. Whereas if you come in as a private lender, then especially if you're secured, and of course your audience knows this one really well, that if you are lending money, then you get paid out first no matter what. So again, using the house metaphor, if two people come in together, they do a deal and they buy a house together, and they buy that $100,000 house, and they get an $80,000 note just from the bank. And let's say the property makes you're able to sell it for $150,000, and there's $30,000 profit split between the two. The bank still gets their $80,000 loan back, and the investors get their equity split. But if the opposite happens and there's losses, let's say you bought that property for $100,000 and end up having to sell it for $90,000, well, the bank still gets their $80,000, right? No matter what. So if the property sells for $70,000, then we have a problem, because then there's not enough money to pay the loan off, and then you got to look at the deal to see what you do then. But so if you invest in a syndication or raise money from others and take it as a note, then of course they get priority over the equity investors. So we structure it both ways on our deals as often as we can, so that our investors have the choice. Do they want to sort of roll the dice and be an equity investor, which means that if there's big profits, they make big returns, but they don't really know what those returns are going to be. They just have to look at the business plan and see if they like it. But they have to understand there could be losses. Then, we offer pretty high returns for those equity investors because we understand the risk. Of course, we don't like taking big risk. So, our risk is still pretty low risk. But even so, there's people who, like the Costa Rica deal, for example, the return is expected to be around 30% IRR. If we don't hit that mark and it's 15% or something, that's still good, but it could be more. We don't really know what in a year from now, when we built the homes, what they're actually going to sell for. We have an idea, but you never know till it's done, right? Whereas we're also bringing in investors who don't want that kind of risk at all. They just want to lend to the company. That's fine. We set up a separate entity for that, and they lend, and they get their money out first. And and it's secured, right? They get their money before there's any profit split, before the developer gets paid or anything like that. So we offer less for the private lenders. They get 15%. Still good, still awesome. And plus, I think on the Costa Rica one, plus 3%. So they get like an 18% interest annualized. And they get paid out first. So, but that's still half of what the equity investors are targeting, around 30%. So again, private lending, more secure, maybe a little bit lower, return, still good though. And equity partnership is not secured, but chance of higher returns. Now, when we structure these, there's another factor too, like I said, the taxes. So on the equity side, that's usually treated, especially mainly when we're building houses, that's ordinary income tax. So these investors might say, okay, well, I'm making 30%, but I might have to pay 50% of that in taxes. So then they might consider the private loan, because that may be taxed differently for them. For sure, in an IRA, it's completely taxed differently. And that's what we mostly have. If you're raising money today or looking to raise money, it's important to understand that there's about $23 trillion in retirement accounts. And that's a ton of money. And so if you want to tap into self-directed IRA investors who want to get their money out of Wall Street, it's been so turbulent. People want something secure. They love notes. Notes are about as passive income as you can get. Then we put our self-directed IRA investors into the note side, into the private loan on our deals, partly because it is so secure and because you can kind of guess what your return will be, but also because it's taxed differently. It's such a passive investment that it does not trigger UBIT within the IRA in most cases, whereas a self-directed IRA investor who would come in on our equity side may get taxed within their IRA and then taxed again when they take their money out of their IRA. So it's like a double taxation, and they need to know about that. So if an IRA investor came in and said, do I want the equity partnership or the private loan, they would have to understand that if they're in a certain tax bracket and they need to talk to their CPA, that 30% return might be 15% in their IRA, whereas the private loan pays 18% and does not get taxed that UBIT. And so they might choose the private loan, which in this case would pay out more. All right. Any thoughts on all that? Should I just keep going? All right. Are you there, Scott? Okay, I'll just keep going. Most RW and syndications are either equity partnerships or private lending, like I said. Investors become a member of that LLC, and the LLC partners with the developer. And yeah, we already did that. So here's a few terms to know in syndications. The capital stack is basically the priority of payout. So like I said, if you go to the bottom, the highest priority in the stack is the secured debt. They get paid first, just like a bank, right? If you sell your house, the bank gets their loan paid back first and you get the remaining equity. The unsecured debt, we sometimes will take unsecured debt, it's corporate debt, and that comes next after the secured debt gets paid off. And then the preferred equity partners, you'll hear often you get a preferred return, and that is that's the preferred equity. So they get paid next after the debt investors, and then all other equity investors come after that. And on our deals, that's the developer, that's the upper management, that's Real Wealth Network and myself. We get paid last, and we structure it that way so that the investors come first. And we want, again, first and foremost, when you're raising money, you want happy investors, and you need to put their needs first before yours. And so they get paid out first, we get the leftovers. And this motivates us, because if we have investors coming in as lenders, we're paying interest on that money. And so if the project is delayed or takes longer, those investors still get their money. The people who pay the price are the management. It comes out of their profit. So that helps us make sure that the managers we partner with, the developers we partner with, and the operators that they are moving quickly and sticking to the business plan, because if they don't, it comes out of their pocket and not the investors. All right. Sometimes there are different layers of entities, and it can be confusing. So, so you need to understand the capital structure or the entity structure of any deal that you invest in or that you create. So on our Reno project, where we're building there, we just have one single entity, and in it there are Class A and Class B investors. That's it, one entity. It's Reno, Bates Stringer Reno LLC, and we know there's the what am I trying? What did I just say? The A and B investors, and so it would be usually the developer or manager or Real Wealth Network would be the Class A, and then Class B or vice versa would be the investor group. And that's how you decide the capital stack on that. And then in our other ones, like Costa Rica, there's like layers and layers and layers of entities. And you need to understand that flow to understand how the money's coming down, just kind of in the same way that you have to understand the capital stack. So in Costa Rica, the only way that we can buy and own property in that country is to have a Costa Rican corporation. And but then we didn't, for tax purposes, we wanted to make sure that what our investors were investing in was a U.S. corporation. So we created a U.S. corporation that bought all the shares of the Costa Rican corporation. And then there were several investor groups who bought from that U.S. corporation, Real Wealth Network being one of them, and then the developer put his money in, and then he had family and friends who wanted to be in. So then there were 3 groups coming into that one. So we need to understand the flow of, from the Costa Rican entity to the U.S. to ours. And so for RW1 investors, it says we get 40% of the profit, but of what? Of which, entity. So you need to be able to see the operating agreement of all the entities in which you're investing. And that's complicated, but it's important to understand because otherwise it can be confusing. Plus, when Real Wealth Network, let's say we opened this entity that invested in the Costa Rica one, well, we have fees to pay. We have attorneys and CPAs. We have our staff. And so there's management fees. So when this entity that we created gets 40% of the profits, the investors don't walk away with 40% of the profits. Some of that's shaved away by the management fees that we have. So again, just know that when you're investing or taking money from others. I already went over the secured debt investors. You guys know this, you're pros. So obviously secured debt is the least risky. Unsecured debt is I don't want to say more risky. It's just next in line. And then we already went over this, preferred and simple equity. So offering documents, if you're raising money, you have got to have proper documents approved by an attorney that your investors read and sign. If you do not have these and you take their money, you are violating SEC law. You don't want to do that. You do not want to do that. Plus, like any agreement, if it's not in writing, you're going to forget, and your investors are going to forget what the deal is. I know this sounds obvious, but I've seen it happen, and I'm guilty of it with one of my first deals where we made a handshake agreement but didn't write it down. And when that property made a bunch of money, there were discussions because the other party forgot the deal basically and could have taken our portion because we didn't write it down. Even though I thought we were friends and we had a handshake agreement, I didn't even bother to send an email to confirm it. And so don't do that. You need to have the correct operating documents that explains who's in charge, who calls the shots, what to do if something happens to that person, when the payout is, how it's split, who gets paid first. All of that stuff has to be ironed out in the offering documents in order to comply with the SEC for sure. And know that anytime you are taking someone else's money and you're investing it and they're not an active player, they're not active in management, it falls under SEC. You've got to make sure that you are raising money properly Because as I said, there's many, many penalties if you don't do it right. So when you listen to a presentation or give a presentation, that's supposed to help explain the deal. But it doesn't really matter. What matters is the document. What's written in the document is the law. It's the legal agreement. And you need to understand it. And they're very legally worded, so it can be hard to read. But that's why at Real Wealth Network, we put on a lot of seminars and webinars like this to help people understand how to read those documents and make sure that they're signing up for what they truly think that they're signing up for. And, we also recommend always go, bring these documents to your attorney and your CPA to make sure you truly understand the risk and that you understand what you're agreeing to and the tax consequences of that. So again, terms to know, offering documents, legally binding paperwork that outlines the terms of the deal. So even if you have a handshake agreement, if that agreement is not in that operating agreement or legal binding document, then it doesn't matter what your handshake agreement was. It matters what's in writing. And a signature, a wet signature is what makes it legal. Most RWN deals at our company include a private placement memorandum and an operating agreement for the LLC and a subscription agreement. And a subscription agreement, we'll go over that in a minute. That's vital. So the private placement memorandum, the PPM, is the legal document that states the objectives, risks, and term of the investment. These are the most important things to have in there. And it includes items such as a company's financial statements, management bios, a detailed description of the business plan and operations, and all the details. Excuse me. So terms to know going forward. The operating agreement, this is for the company that you form or that you're investing in. And it's, again, the document that customizes the terms of the company according to the needs of the owners. So it outlines the financial and functional decision-making in a structured manner so that there's no confusion when it's time to disperse the funds or, memory loss. The document, once signed by each member, acts as a binding set of rules to adhere to. And it's drafted to allow owners to govern the internal operation according to their rules and specifications. Subscription agreement. This is where the person investing in your deal, or if you're investing, you'd fill out the subscription agreement because you have to actually apply to invest in a syndication. And you have to kind of explain your ability to invest. You basically, the SEC only wants accredited investors to invest in syndications and private placements. They let the general public invest in public, obviously public companies, and you don't have to be accredited. But in private placements, I guess the SEC thinks that private companies are not as solid as public ones, which is definitely not true because 75% of last year's IPOs were in the negative. There's never been a profit. So I don't agree that public companies are safer. If anything, they're not. But that's the way the SEC sees it. And they think, all right, if you're going to do a private deal, raise money for your private company, you can only raise it from accredited investors. But then they do give some exceptions. In some deals, you can have 35 non-accredited. And that's what will be explained in the subscription agreement, is the investor talks about their financial background, their ability to invest, their understanding of the syndication, that they have the ability to truly understand what they're doing, and that you're not just taking the little old lady's money next door. So you fill out that subscription agreement, and then the management reviews it and makes sure that this person is eligible to be in your deal. We have found at Real Wealth Network that the less amount of money that someone invests, the more panicked they are. If it's kind of like their last dollar, they're the ones who are kind of emailing you every day.
Are you saying that they're a PITA, a pain in the ass?
I'm saying that they're scared. And so because it's, if they're putting in their last dollar, and you don't know that, that's a little too risky. So what we suggest is only investing 10% of their net worth. And that way, they'll be more comfortable. But in the beginning, we didn't know to look at that. And we found, some people literally would invest $50,000 and that was all they had. And that's cause for concern, right? They would be nervous about every little thing. And projects, face it, not every project goes as planned, right? And in fact, I don't know if it ever has gone as planned for us. There's always some kind of monkey wrench. There's always something that you have to work around. And, accredited investors who have maybe more to lose, at least that's the thinking of the SEC, don't stress out as much about it. And that's also why we like to have people put a little bit of money in a lot of deals so that they're really diversified, like I said earlier. So I'm going to talk about, the difference between accredited and sophisticated. An accredited investor, at least defined by the SEC, is someone whose annual income is $200,000 for an individual for the last 2 years, or $300,000 if they're married for the last 2 years. They would need to have earned that. Or it's any of these, or has a net worth over $1 million, excluding the primary residence. And so net worth would mean, liabilities versus assets. So it's not just, hey, I've got $1 million in the bank. You can't just send me a bank statement showing $1 million in the bank, because what if you have $2 million in liabilities? Then your net worth is not $1 million. So there's a whole process in determining if you're an accredited investor or not. And as the syndicator, as the person raising the money, you really do need to have a pretty good idea of the net worth of the people investing, because at the end of the day, if you take money from somebody who doesn't really have a lot of money and they ask for their money back, even though all the operating agreement and everything says you can't get your money back, we bought this property with it, it's tied up, it's a 5-year investment, whatever it is. But if that person put their last dollar in, there's a good chance they can argue to get it back if they can show distress. So you need to be aware of that and have a reserve fund, or just make sure that the people investing in your deals can afford to not have that money during the term that that you're investing it, or if things went sideways, that they would be okay. So that's the definition of an accredited investor. A sophisticated investor, like I said, some deals you're allowed to bring in 35 non-accredited investors, then they would be considered sophisticated. And this is a very gray area with the SEC. There's not a real definition for what that means. But the typical definition, or the technical, is a type of investor who is deemed to have a sufficient investing experience and knowledge to be able to weigh the risks and merits of an investment. So our attorney suggested these parameters. Again, it's totally gray and it's up to you. But they suggest an annual income of $150,000 for an individual, or $200,000 for a couple, or a net worth exceeding $350,000. Okay, so here's what will determine who you can bring into your deals, or if you can invest in certain deals. So again, some projects, as I said, are open to accredited investors, and some are open to accredited and 35 non-accredited. So what's the difference and why? Because sometimes, like our Costa Rica deal, we can only take accredited, and some people are really upset about that because they want to participate. Whereas our Reno deal, we were allowed to bring in some non-accredited. So this is the simple overview of it. 506B, these are Reg D exemptions for the SEC, which means you don't have to file enormous amounts of paperwork and do what public companies have to do. You could file this Reg D exemption, which means you do very, very, very limited paperwork with the SEC when you file the Reg D. And there's two kinds, or there's several kinds, but these are the two we're going to look at today. Under the Reg D, there's Rule 506C and there's Rule 506B. So let's start with the one on the right, actually, because this is the oldest one. This is the one that's been used for many years, It's what Real Wealth Network uses for the most part because of its flexibility. So a Rule 506B is open to mostly accredited investors, but you can also have those 35 sophisticated investors. So, we have such a large network at Real Wealth Network that we can use this Rule 506B. So what I mean by because we have a large network is that we can only present deals to people that we already know. So I can't talk about it on my podcast. I can't on the Real Wealth Show or Real Estate News or in our webinars or on a forum like this. I can't talk about specific deals. We've got amazing deals that I'd love to tell you about, but I can't because I don't know some of the people listening right now. And so with a 506B, you can only tell people about these deals. You can only tell people that you already know and have a pre-existing relationship. And on top of that, in that pre-existing relationship, you have a very good idea of their financial situation. That's kind of what the SEC is wanting, that you kind of reach out for the friends and family type thing. Friends and family and Real Wealth Network is 36,000 people, so we have a huge network. And we have to prove that we know these people, that we've talked to them, that we've met them, that we've got a good idea of their financial situation. We've had them in our website, not our website, in our database. We have a pretty good idea of their net worth and the amount of money they have to spend, what they do for a living. That's we have a great and sophisticated database to keep all those details. But if you were ever audited, you'd have to be able to prove, yes, I met this person on this date. This is when they joined our network. They came to this event. This is when we called them. And you've got that track record to prove that you have a pre-existing relationship. And that pre-existing relationship couldn't just happen like an hour ago. Like I'm at this conference right now, and I just met a bunch of people. I can't now, an hour later, tell them about my deal. It doesn't really work that way. There has to be kind of some people say at least a few days. Some people say a few weeks. There's no real answer on this. Some people are, like 3 months or 6 months. Some companies, syndicators will say you need to show 3 or 4 touch points. Again, you've emailed, talked to, met, these different things. They filled out a questionnaire. So to be super safe, we like to make sure that we have been warmed up to whoever the person is for at least a week, but it should be more like a month, maybe 2 months that you've known the person you're presenting to. And when you've done that, then when they subscribe, when they fill out the subscription agreement, when they apply to do your deal with you, all they have to do is fill out a form, and they tell you, they write down their financial information, and if they're accredited, they just self-accredit. They just sign it there. There doesn't have to be a third party. So that's what kind of makes the 506B easier. You have to have a fairly large network to do it. You need to be able to know a lot of people. But if you do, then the paperwork is just a lot easier. Plus, you get to allow those 35 non-accredited investors. And at Real Wealth Network, some of our deals are so juicy, they're so amazing that if, I don't mean to be bragging, but really, like at this point, we've got so many great developers and operators coming to us with fantastic deals that our non-accredited investors get really upset if we don't file 506B because they want to participate. But then there's some deals that that we do file as a 506C. So that is a new exemption that came out in 2012 through the Jobs Act. It's the Jumpstart Our Businesses through Obama, that act of 2012, where the new crowdfunding rules came in. So it's kind of easy to remember. Rule 506C, think crowdfunding. And this is why you see all these crowdfunding portals everywhere. Because in 2012, the Jobs Act, for the first time in the history of the SEC, private companies are allowed to kind of go public with their deal. They're allowed to bring in money from people they don't know, and they're allowed to advertise it. That's why I can talk to you about Costa Rica, because we filed it as a 506C. I wouldn't be able to talk about it if we filed it as a 506B. And since, so you might be wondering, why did we file Costa Rica versus, why do we file that one as a crowdfunding deal and our others not? Well, the thing about the Costa Rica project is it's such an interesting project. We're building a state-of-the-art retreat center, think tank, community with a school on it. We're growing organic foods, exporting it. We planted 10,000 trees. We have Jason McLennan, who did the design for living buildings, which means that everything, all the materials are living and breathing, and they give back to the earth. There's no toxins. It's a really world-class property with a world-class brand. It's Rise Costa Rica. And because of that, I just wanted to talk about it, and then I had several magazines, national magazines, who wanted to interview me about this project because of some of the superstar players involved in it. And I wanted to be able to do those magazine articles, and I wanted to talk about it on my show. And I just had to go to our non-accredited investors and apologize and say, I'm sorry you can't be in this deal, but there'll be other deals for you. So we filed it as a 506c, and the rules on that are that you can talk about it, you can present it to people you don't know, you can advertise it, but you have to prove by a third party that the investors are indeed accredited. So they can't self-accredit. They can't just fill out a form and turn it in. They have to get their CPA or their financial planner or their attorney, or they can go to verifyinvestor.com and get, fill out all the forms there and get a third-party verification that they are indeed accredited. And only then can they invest in your 506c. So it's a big pain. I'm be honest with you, it's such a pain. It's a pain for us as the syndicator. It's a pain for the investor because they have to go do that unless they have a really great team that's happy to just write that letter for them, which a lot of our investors who are high net worth have that legal team that is like, oh yeah, sure, we know your net worth, and they write the letter. But it can be a bit of a hassle, but it is just how it is. And so you just have to prove that you are accredited, and that's it. That's the only difference. All right. So how you join a project or how you get other people to join your project, you get all those operating agreements and offering documents in place. You give them to people. Make sure that if you're doing the offering, that when people turn in their paperwork, that you have it turned in a secure way, because man, with internet fraud happening, if you are the company that didn't have a secure way for people to get their financial information to you, there could be huge lawsuits there for you, and you don't want that. So never, ever have people send their financial information through an email. It's not good. We do it through a private server that people can upload their documents in, just like your CPA should be doing with you. Your CPA should never be emailing you any tax documentation ever. There's so much fraud out there. So make sure that if you have offering documents and people are sending these accredited investor forms or any financial information, that it is on a private server or on a private, like we use Box. So it keeps it secure. So you review all the documents, discuss it with your attorney, and then just for the person filling it out, they have to decide how they're holding this investment. If it's in their personal name, it's an LLC or a trust or in a self-directed IRA. There's rules around that. Some IRA companies will want to be the ones who fill out that subscription agreement, while others say, no, you have to fill it out. So it's kind of a strange thing, but your IRA custodian would know how they do it. Fill out the subscription agreement based on how you want to hold it, and then you submit it through that secure way. So the way we do it, like I said, it's pretty simple. You have to send your W-9, your photo ID, third-party verification, signed operating agreement, and you just upload it there on our little widget that goes up in Box. Okay, this is our team. We do it all in-house. You can hire companies if you're the syndicator and you're raising the money. you can hire companies like WealthForge, I believe it is, and I think there's another one that will act as a broker dealer and will take care of this paperwork for you if you want. There's a pretty hefty fee for that. So we just do it in-house. This is our team. It's so busy. We did 1,100 K1s last month.
Wow.
Whatever projects we're in, it was completely overwhelming.
Well, but aren't the fees, a lot of the fees, the crowdfunders are what, something like between 6 and 10% of the amount, something like that?
Yeah. So we just found that we prefer doing it in-house, and that way when our investors call and they have questions, we're not using a third party. We have our own team that understands it. But if you're not there yet, then it's probably worth it just to use either a crowdfunding portal or again, WealthForge or something like that initially while you're getting it done. Or if you have a really great project and you want funding for it, you can come to Real Wealth Network. We'll take a look at it and see if we can fund it for you. So there you have it. If you're the operator, the syndicator, then after you invest, after the investment's been raised, you've got to do quarterly updates. That is really important. Even more frequently, the more you communicate with your investors, the better, without totally bogging them down. They don't have to know every detail, but we post it all. We have a page for each project that we're doing, and it's got all the updates there and all the details. And if they want to know day by day what's happening, they can go log in. We're not going to send them emails every day. We just send them emails for the quarterly updates. All right, and then if you're offering the syndication, you get to do those K1s. It's awesome. So, our CPAs, of course, do the do all the taxes, but then we individually send the K1s out because we have the investors' information, and that was pretty overwhelming. They need to come out by the end of March, and some companies new to this don't realize that and end up with a lot of angry investors who didn't get their K1s. All right, so that's pretty much what I was going to share. Is there any questions you have?
Yeah, we got a few questions from some people on here, so definitely great stuff. Kathy, definitely great presentation walking through everything. It's phenomenal. Let's see here. Scott asked a question. He goes, for 506B deals, does there have to be a ratio of accredited to sophisticated investors? For example, would it be okay to have 1 accredited and 35 sophisticated investors?
That has never come up before for us, and I don't think so, but I would definitely talk to your attorney. That is something I've not been told.
Okay.
What's been surprising we're located in the San Francisco Bay Area, so $200,000 income is like the only way you can live there and survive there. So most of our investors are accredited. We haven't had the problem. We're actually shocked. We thought we'd have more non-accredited, but we don't. But I would definitely ask that question to your attorney, and I will certainly ask mine. It's a great question.
Another question from Eric. He goes, do Reg D exemptions apply for smaller amounts of money raised, say 25K, or is it no matter how much money is raised?
That's a great question. So attorneys are so expensive, and this process of filing with the SEC could be expensive. And if you take money from different states, we sometimes have people from 10 different states, and you have to file in their state. We just got a bill for $10,000 just for filing Blue Sky Law, to comply with Blue Sky laws, taking investor money from different states from where the project is. It was $10,000 just in fees. So to raise money for a $25,000 deal, I would not syndicate because it's so expensive just to get your documentation and open up the LLC and do the taxes and everything. I would probably work out a JV agreement or something, some other way of structuring it that isn't as expensive.
Yeah, that's definitely, I'd agree. Just doing a JV deal or, we've got Jillian Sadati on. I think you're familiar with Jillian.
Yeah, of course.
Individual JV deals for something like that. That's what I would recommend. Definitely. Yeah, because we've got a 506A in the process of being filed. It's expensive. It is. Yeah. I wish it was 25K in fees.
Yeah. Yeah, no, it's probably closer to 50, right?
It's we're beyond that. We're beyond.
Yeah. So I mean, I use a really high-end attorney. I don't know why he's too expensive, but even for our regular deals, we pay 50 to 75,000 for our offering documents alone. But that's for like 10 and 15 million dollar raises. But for anything under, oh boy, there's one crowdfunding thing I didn't mention, and that is Title 3, I think it is. You can talk to Jillian about it, and that you can. It's a kind of you could take non-accredited money, and you can only raise up to $1 million, but it's still expensive to put together. So I would definitely have Jillian talk a little bit about how to do JV deals that don't require so much legal.
Yeah, she will a little bit. I think we've really got her going about that. That's a good thing. Let's see. Okay. Gail says, great presentation. I've been a member of RWN for a while now. It's awesome. Back when I was a full-time rehabber, great stuff from Kathy and Cam Dunlap.
Thank you.
Let's see here. Clark asked the question, what is the difference in raising a fund that caps the amount of the raise? I don't think that's a full question there. Clark, can you be a little bit more specific what you're talking about in there? Okay. So Eric asked a question. He goes, question 2 for you. What if someone reaches out to me asking me to place their money into deals, not as crowdfunding, but the whole funding? Do these rules apply?
They do. It's SEC. Anytime you take somebody's money passively. So I'm guessing what Jillian's going to say on the JV thing is, let's say you're raising $25,000 and a friend or family member wants to invest the $25,000 from their IRA. You just bring them in as a partner and have them do something active, so that it's not. It's just like it can't be totally passive.
That's the thing. It's a good thing. Have them do the due diligence. Have them look through it there with you. Share what's going on. Get them involved in questions. That's the kind of thing that is helpful because it's documentable.
Yeah, exactly.
And honestly, too, you talked about this beforehand. You guys do a really great job of being able to track their systems, track when you email people, track when you talk to them, track when they came into your kind of arena or into your system, basically is the best way to say, right? Into your network.
Yeah. I mean, we have, invest. I mean, you don't have to spend a lot of money. You can probably even have, whatever the basic contact records. What am I trying to say? A
CRM tool.
Contact management system. Yeah. That will track that. But like anytime when somebody joins, they come to our website, they fill out the form, bam, it just goes straight into our contact management system as this is the date they came in. And then when they click on a webinar, it automatically goes in and says, okay, they watched this. And then we have a customer service person who calls them immediately as soon as they join and has a conversation, asks questions. That's all documented. And then the key is, like, we really want them to come to live events, because then we can say, yes, we've actually met as well.
Right. And then you also probably have a pretty in-depth investor profile sheet that you have them fill out too.
Yeah, exactly. Yeah. When they join, we ask some questions and then that goes in, and because that helps us to understand their net worth and so forth.
Sure. Good stuff. Okay, here. Can someone set up a syndication and then invest in notes with the fund? Yeah, John, definitely. You can definitely do that. So to buy.
Definitely.
Yeah. Clark says, okay, some mutual funds cap the fund. Do you have a cap since you may not have enough deals to put the money to work? So you're saying you cap a fund like at 25 million or 50 million or 5?
Okay, gotcha. All right, so that's a great question. There's a difference between a blind pool fund and what we do. So, and you need to be super careful with the blind pool ones. And what that means is, let's say I said to you, hey, I'm super good at finding single family homes. We have networks across the country, which we do. And, but actually we do have, now that I think about it, a blind pool fund. If you know me, you know that I'm an expert in single family rental property. And so I might say, I'm gonna raise $10 million, which is what we did. And we're gonna pick out the properties for you. But right now, I don't know what those properties are, because I need your money first. So we have to raise the money first, and then we're gonna go buy those properties. But I can tell you they're going to reach these parameters. This is what we're looking for. We're looking for a 10 or 12% return, and we want, this much equity in the deal or whatever. Then that's what we'll go out and buy. But you don't know yet what we've bought. That's the blind pool. And on those, I don't know, that'll be a great Jillian question of what the max is, but I don't know if there is one, but if it is, it's super high. Like, probably, I don't know. Do you know, Scott?
It varies a little bit. I know she's done some bigger stuff, but she's also done some smaller stuff too.
Yeah,
So,
I mean, it's probably like 50 million or so.
Yeah,
I mean,
I want to say it's 50 for the most part. We've got some buddies that have done have $100 million fund that they chase, BK chapter 13s with, but it's, that's a specific asset they have a class in there. So it's not really true blind, but that's why it comes down to the kind of the specifics of the operating agreement. You have to outline kind of what you are chasing.
Yep. And make sure, it's like if you don't know what the asset is, if it's just, hey, we're raising money, we're going to do this, make sure it is so specific that they're not just like, oh, we decided to, get to buy this apartment instead of, the commercial building, and you didn't want to be in apartments or whatever. So just make sure that's so specific. Like in ours, we say fully renovated rental properties and growth market. It is so clear what people are getting, and we totally hit the mark. We exceeded it. But most of our projects and syndications are not blind pools like that. They're an asset that we know we're buying. So, like the Reno one, it's okay. We're raising $16 million. We're buying this piece of property. We're entitling it, building. We're selling half the lots off so that we own the rest of the land that we're developing free and clear. It's a great deal, by the way. And so you're going to be safe in here because we're going to have a zero basis on this because we've sold half the lots to someone else to pay us back the 13 million that everybody invested, and this is the return. And so you know what you're getting. It's a one asset deal syndication, and that's why at Real Wealth Network we have 20 companies, because each deal that we do like that, we have to set up a new company, a new LLC, and it's this project. If we had taken all 10 projects and put them into one fund, there's no way we could have possibly known what we were going to buy, and that's the blind pool. They're riskier. But if I were investing in a blind pool, I would make sure I knew exactly, you want to make sure that there's a close date, because that's when the Ponzi scheme thing happens. The Ponzi idea is, you've got this investor money and you bring in new investors to kind of pay them off, and you want to make sure if you're investing in a blind pool that there is an end date from when money can come in. Does that make sense?
Yeah, most of those are usually 24, 36 months usually.
Something like that, yeah. And even that to me is kind of long. It gives that operator a little too much time to Ponzi things around.
Sure. No, it makes sense. He also asked, are there capital calls, or do you get all funds invested prior to the deal?
Depends on the deal. I don't like capital calls, but you kind of need it in the documentation, in the event that that's just the only way it goes. But when we've had capital calls, we have made the developer come in with the money, or we've had a side agreement where we could have other investors come in, and those investors would come, their share would come out of the developer's side. Because personally, again, like happy investors means you stay in business, and if you have to do a capital call, they don't like that. But but there are certainly lots of companies that have them. We have to have it in the documentation, but we don't do it.
Good stuff. What are the questions you guys have for Kathy here? What questions? Great stuff, Kathy. Really great stuff.
Awesome. Thanks.
What are you speaking at at the event you're at? Are you speaking on a similar topic?
This event is so intense. I kind of feel like crying. It's actually a depressing event. It's the real estate guys' money. It's all about the future of money. And I just heard Simon Black speak, and Russell Gray, and there are definitely some cracks in the armor of the U.S. economy people don't want to talk about, and it's mostly debt related and the trade wars. It's concerning, very concerning. I kind of walked in here feeling a little depressed, honestly, because we haven't gotten to the opportunity yet. We just got to the problem. So I want to let you know that that's why at Real Wealth Network, we are so cautious. We have one foot on the gas and one on the brake at all times, because the economy could go either which way. We could be in for a massive recession if this trade war leads to out of control interest rates, which is possible. So we're at a turning point where if you're raising money or investing in deals, you have to be so careful. that either scenario, we could have a boom, we could have a bust. Are you going to be okay? Because it doesn't matter if you lose investor money based on things out of your control. It doesn't matter. I know a guy who had a big fund in private notes, actually in notes in I think he was in Atlanta. His father-in-law invested $5 million in his fund. When the market collapsed in 2008 and investors lost everything, including his father-in-law, they didn't just go, oh yeah, it was a messy time, everybody lost money. They sued him and he lost everything, even though it was out of his control. So you have to be aware. That's why I do so much research on the global economy and the national economy, because I'm responsible for over $100 million worth of investor funds that if things happen out of my control, they're still coming after me. It's just how it is. And so when we do things like our Reno deal, I already mentioned it, we bought land, entitled it, and we knew we could sell half of it for the same price that we paid for all of it. So now what we have left is land that we own free and clear that we're developing. If all hell breaks loose, we're okay. We don't have debt. It's fine. And when we raise money for our next project, which we're raising for right now, it's all cash. Mm-hmm. We're going to ride it through. On our single family rental fund, those are cash flow properties that we got for very cheap and that are high cash flow in growing markets. And we really feel that they can survive a downturn. But you've got to be cautious. Do not jump into something you don't totally understand, or, don't think that the economy is nothing but solid. There are some serious issues that we have to deal with that could affect all of us in a serious way. And it's these trade wars, man, it's terrifying.
Right. A couple questions before we let you get out of here. John asked a question. If one uses a self-directed IRA, needs annual valuation, what is provided to an investor by syndication to aid in that process?
For revaluation of the value of the property?
Well, basically, yeah. If they're using, the IRA companies have to provide an annual statement of the value of their.
Yeah, we've gone over this a ton. I mean, you could go as far as like actually getting a valuation and paying for that, or having enough evidence of what you think it's worth. Mm-hmm. You have to turn something in that's legit. It could be some kind of audit, somebody official, a BPO of some kind. But yes, some valuation has to be considered. We will look at our K1s and kind of use that information, but even that is not enough sometimes for IRA companies. They want something else, something more from a professional. Or let's say you, like with our Costa Rica project, all we've done is we bought it for $4 million and we entitled it, and we got an appraisal on just the land, which was, I don't know, $5.5 million or something. And then but we also invested another $1 million in this really kind of upscale glamping, like camp,
yeah,
camping. And so it's really, that's with that $1 million, even though it wasn't on the appraisal, it's like, okay, the appraisal for the land came in at $5.5 million, but we invested this $1 million, so it's $6.5 or $7 million, and you have to justify that and then somehow officially.
In a blind pool, how do the investors ensure that funds aren't being used without their being told, or on the side, so to speak?
It's a huge risk, and let me tell you, in my 20 years experience, there's more shark. This is a more shark infested world than where I surf in Malibu, which is right by a shark breeding area. So I mean, there's so many people who don't care about you or your money, and they're selfish. So it's a big risk. I'm very cautious of blind pools. I would be careful of them, and the only way I would ever invest in one myself personally would be as if it was required to have an annual audit by a third party. That's the only way I would do it, because it's too easy to just.
You mean you don't want the guy showing up in a Lamborghini like a month after the deal gets funded?
These two people in Orange County who were really high level real estate, really high level and well-known, well-respected real estate investment group, they just got caught embezzling millions. It's like, and these were friends. It's crazy. So don't, be careful.
Yeah. I'd make sure the guy's driving a Ford F-150.
Yeah.
Or Dodge Ram, something. I mean, that's the thing. You have to keep in mind. That's the thing I always tell people. Like, look, if you're doing what you're doing, you don't need to have Lamborghinis or the private jet or that stuff. Like, don't get me wrong, that's nice if you've done it for years and stuff like that. But if somebody's doing that, that stuff, those are expensive habits to have to be fed. That's usually the first smell test if something's going wrong, right?
Well, especially like you need to know where that money's being spent. One of the syndications we did earlier, we were looking at what the manager was spending money on, and one time it just looked like a rental car fees were too high. I mean, this is how detailed we get on our books. And it turns out he was, renting a pretty fancy car when he went to visit the site. And we're like, no, that's investor money. You spend money doing things like that with your own dime, but not with investor money.
Mm-hmm.
Yeah, no. You've got to separate the two and never commingle. I walk into Bank of America now and they bow to me because we have so many accounts. You have to have a different account for every deal, every syndication, no commingling, has to all be separate.
Yeah. One last question here. What news source other than the mainstream sources do you recommend to keep a pulse in the world economic news?
That's a really good question. I'm really looking at alternative news for the most part. I could tell you this event I'm at right now is phenomenal. So Simon Black is here, Chris Martenson. These are names I would definitely look into. Robert Kiyosaki, Peter Schiff. Yeah. People who just aren't buying the mainstream news. I mean, Simon Black just went over our operating budget for the U.S. and we're negative $1 trillion. It's on the U.S. website. Our operating expenses in a good market, in a booming economy, when everybody thinks everything's great, we're a net loss of 1 trillion every year. Like, how is that? What happens if we go into a recession? This is during good times.
Yeah, that's
so yeah, you got to get your news from the right sources. Right now, people are being misled, thinking that everything's fine.
Amen to that. Well, on that positive note, hey,
but you can profit in
yes.
We profited in the recession. Our investors made 20% returns in the worst of the recession. So you can use it to your advantage. You can make money in any market, but not if you're blindsided and not if you're making the wrong decisions at the wrong time.
Yeah. You get a lot of money in the down market by buying distressed debt. Definitely.
Yeah, absolutely.
Amen to that. Well, Kathy, I want to say thank you again for joining us. As always, it's great to have you. Hopefully you got the package I sent you with your noisemaker in it that I sent over.
I did. Oh my gosh, I thought I thanked you. We love it. It's so fun.
Good stuff. Well, hey, thank you for joining us. I know you got a busy schedule. Have fun. I know I was looking at the itinerary for that because somebody asked me to be on it, and I was like, there's no time for fun on that cruise. It's event after event after event there for you, it seems like, huh?
It's actually so much fun. It's so much fun that my 18-year-old daughter wants to come back, and she's a sorority girl at San Diego State where there's a party every night.
There you go.
She's willing to give that up for a week to go on. It's actually a great time.
Good stuff. Well, hey, have fun. Be safe out there, and we'll see you when we see you. All righty?
Bye. Thank you.
Bye. Thanks. All right, guys. Hey, that's going to wrap it up for this session. We're going to take a quick 12.5-minute break so that you guys can go grab a quick cup of coffee and get resettled for our next speaker. Arnie Abraham is already logged in here. Going to be a rock and rolling. He's the king of the Texas tax lien game. And so if you've ever wanted to learn more about that or learn more about that specific aspect of note investing, you want to join us here in room 1. Over in room 2, this time it's going to be actually Martin Sines from Note Investing Made Easier. Going to be sharing some of the insights that he's had in his in the last 5-6 years of being a note investor as well. So we'll see you back here in roughly, like I said, 12.5 minutes. Bye.
All right, there you go.